Barrel rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm the senior trader for the Forex Super Model, and this is Trading Psychology Series Part 6, Sentiment, Expectations and Tone. So what do we mean by this really? So looking at sentiment then, basic definition of sentiment is exaggerated and self-indulgent feelings. So it's a sort of a touchy-feely type thing as opposed to hard data. So why are traders and the markets interested in market sentiment? So that's that. Expectations then. Well, expectations are strong beliefs and what we expect to happen. So that sort of ties in with other things like consensus views in the economic calendar, as well as this sort of more wishy-washy expectations of other things happening in the markets. So that's sentiment, expectations. And tone, well, what do we mean by tone? General character, attitude of a situation. That's what is a reasonable definition of tone, and that's sort of, those are general terms which don't really help anybody in trading, but it's a good starting point. So what we look at in the Forex Super Model then, a lot of people are quite keen on this idea of market sentiment and how if you can decide a change in market sentiment or you can see a continuation in sentiment, then that you're pretty much home and dry on direction on your trades. Well, that's part of it, and expectations and tone are all wrapped up in that sort of situation. So let's make a start then. So if you view these things in terms of a structure, so if you've got a neutral situation, so you've got neutral sentiment, and then you've got maybe positive sentiment, and you've got negative sentiment. So that's a sort of, as usual in our organisation, we like to sort of, box things in because we're modelers, and so this would be a way of showing a sentiment, expectations, tone structure. So is it neutral? Is it positive? Is it negative? So that's the starting point for thinking about things. And then obviously all this is only really relevant to price action. So with FX pairs, it's because they're two-dimensional, there's a front and a back part of it, then you can't just go say that positive sentiment means the market's going to rise, and negative sentiment means the market is going to fall. So, but however, with commodities and things like that, you can probably, that's a better analogy. So oil, for example, if you've got a positive sentiment, expectations and tone for the oil market, it's reasonable to assume that crude will start rising and vice versa. So, but with say the euro dollar, that would be a scenario for, positive sentiment on the euro end would work for that, but obviously positive sentiment on the dollar wouldn't work for that. All we're saying is that if you want to model something, you need to. It's more complicated with FX than it is for, say, commodities like oil or copper or whatever. So that's a starting point. So how do we really go about looking at these things? So let's get rid of this then. So in shorthand then, so we call it SET, sentiment, expectations and tone, and you can also add noise onto there. And if anybody who's heard my piano playing will know that that's quite negative noise. Now, we'll talk about noise in a minute, but the way we tend to look at sentiment, expectations, tone, noise, etc., is fundamentally in the following way. We look, is it fighting the metrics? Right, so what do we mean by is it fighting the metrics? Well, basically we're looking at a series of components which form our metrics in the modelling, and is the sentiment fighting the metrics, or is the price action fighting the metrics? In other words, is our sentiment, expectations, tone in line with the price action, or are they opposing, etc.? So is it fighting the metrics? So one of the most traders are going to be looking at data prints. So data prints, so via the economic calendar. So if you get, like, I don't know, strong CPI data out of Germany, everything's going well, and you're getting expectation. The data comes out well ahead of expectations, and then you get a euro complex fall. Then, in a way, the data is the price action is fighting the metrics there. It's fighting what the standard transmission would be, and what most people would expect. And then all the traders come out and say, well, that's because it's been priced in. It's buy the rumor, sell the fact type scenario. And all this sort of, but ultimately this is sort of a fairly woolly principle, because it's very hard to nail down. So the obvious one then, in terms of what our metrics are, most people use are data prints, and then you've got things like speeches from the central bankers. If they're dovish or hawkish, are they fighting the metrics? So that's one other thing that you can be looking at. And then complex positioning really is what we look at as a main feature. So complex positioning. Now, again, if you don't know what complexes are, we've got educational videos on the site, what are complexes and how to calculate them, etc. And we use them in the daily briefings every day. But basically, complexes are groups of pairs that make up a certain complex. So complex positioning then. So we have because we've modelled these things, we have a very good handle of where. So for example, the euro, if that was our floor for the complex, and that was our top, and the euro was sort of operating, up there, then we would be aware of that complex positioning and be factoring it into this sentiment, expectations and tone, and it's very important. A lot of traders pay attention to the COT, which is the Commitment of Traders report, and this sort of gives positional data, but it's quite lagged and quite out of date, and we really don't pay any attention to the COT. So I think I'll rub it out to try and show that we don't pay any attention. But if you do use it, just be aware that it's not, in our opinion, a very accurate measure. It's very lagged, very rear view mirror, and quite often quite misleading. So, but the COT, Commitment of Traders report, is one way that the sort of rank and file trader looks at positioning in the market. So we look at complex positioning, and we also look at it in terms of market positioning, so in terms of our model positioning. So if we've got a situation like this, supposing we've got the pound as the unopposed positive driver, and then you've got, it doesn't really matter all of this, it's just for example, so dollar euro, yeah. So we've got the pound as the positive unopposed driver, and let's change this for the pound then. So this is our positional situation for the pound. Then we know that these situations tell us one of two things. They tell us that we're near a top because it's a positive unopposed driver, or we're at the start of a big ramp up in the pound. So what helps us decide whether this is one or the other via this sort of sentiment, expectations, tone framework is the complex positioning, if you like. So if the complex positioning in the pound was very near the top of our model top, then we would be much more inclined to view this unopposed driver here, positive unopposed driver, as a top, rather than positioning to ramp up in the future. Now, that is obviously important because it affects how you view this sentiment, expectations, tone data as it comes out. So it really revolves around complex positioning, which we model and are aware of. So that's that sort of situation. And so the pound in this situation would be viewed as much more likely to be a top than a continuation or the start of a ramp up. And so really, in a way, we're looking at is the market and the positioning divergent to the sentiment, expectations or tone, or is it in line with it? So that would be important to us. Now, bearing in mind that these are sentiment, expectation, tones are by definition sort of wishy-washy, touchy-feeling type metrics in the market, and we try to link them to our more robust metrics via this structure. So that's what we're trying to do. Now, if you look at noise, so here we are, noise, right? So now noise needs to be looked at in two ways. What direction is the noise, and what volume are we talking about? So it's direction and volume. So what generates noise? Well, analysts tend to generate noise, and social media generates noise, and things like that. So how much are they banging on about something, and how loudly are they shouting about it? So the direction and the volume is critical as far as we're concerned. As I say, the tendency is that you're getting near a sentiment, expectations, tone, peak or floor when the noise is really very loud. So we try to measure this intangible concept noise in terms of this volume and direction, but predominantly the volume and the intensity will tell you how close we are to a perceived sentiment, expectation, tone, top or floor. So that's another point worth noticing. So there we are. To sum up this whole sort of idea, then you've got sort of intangible market concepts like sentiment, expectations, tone, and noise, which sort of, it's a sort of cheat in a way. Analysts sort of use this as cover quite often to say, you know, that the general tone, it's quite wishy-washy, and they used to call it a leafy lane argument. The wind will blow the leaves one way, and then the breeze will blow them back. It's very leafy lane. There's very few analysts that will stick their neck out and say, this is what's going to happen, providing this, this and this. So what you've got to bear in mind, is that when you're looking at sentiment and expectations, tone and noise, the first thing to do is to ask yourself, is it fighting the metrics? And what metrics is it fighting? Is it fighting data prints? Is it fighting speeches like dovish, hawkish? And what is the complex positioning that the data or sentiment, expectation or tone is banging on about? So if it's banging on about the dollar, you need to be looking at a dollar complex. You could be looking at things that are very dollar correlated or negatively correlated, like bonds and treasuries, and gold, for example, might be something you could have a look at as well. So you'd be looking at that, and then you would need to get yourself to a position where you had a good feel for where the dollar complex was. And if you're talking the dollar complex at a very basic level, you could be looking at the dollar index, rather than assuming you're not modelling the whole thing like we do, but you could get a feel for where the dollar is via the dollar index. It's not totally reliable, but it's a start. So you want to get a feel for where the dollar is, where the dollar primary pairs are. Are they fighting the metrics? Then you've got a feel for the complex positioning. We look at the actual modelling bracketed flows. And so we know the monthly, weekly, daily, intra-week flows, etc. So we've got a good measure on that. And then you're looking at the noise. Are we near a peak or a trough? Is everyone and his dog talking about the same thing? And are they talking about it loudly? So, and if they are, you're probably getting near a turning point for your particular complex or pair or whatever they're talking about, commodity, be it whatever. So hope that was useful, and watch out for the next in the series. Thank you very much.